Prateek Agarwal joins us, business head with and CIO with ASK Investment Managers. Prateek, good morning. Thank you for joining us.
Good
Prateek, it's been a
morning.
good year. It's been a good year. It's been a great year. If you've been fully invested in this market, what is in store now for the coming year? Are we in for flat returns, no returns, negative returns?
No, I would say a rational thing to expect at this juncture would be to have a return expectation which is below earnings growth. Next year earnings growth is expected to be 15 to 17%. Any numbers between 10 and 15% should be a decent expectation.
What should be the basic focus in terms of overweight and underweight positioning? Everybody is bullish on economy, but yet banks are coming back. While everybody is not extremely convinced about valuations of IT, yet they continue to outperform. So let's start with banks. Why are they underperforming? Is it technical in nature? Is it only because of FI selling?
No, banks, let's divide into two. There were corporate banks, there were banks which were focused on SME and smaller ticket lendings. Now, what has happened is SME and smaller ticket lending stuff that we are also focused at, where we believe businesses will sustain for longer, where margins will sustain for longer, etc., actually got impacted much more adversely by COVID than corporate banks. Okay, so if you divide and then see corporate banks, they have performed quite well. The start point for the other part, retail focused banks was higher valuations, which also needed some amount of correction, coupled with the fact that two of them saw regime changes. The newer guys would have to spend some time for the market to gain confidence again. And one more name is expected to see a regime change at the top over the next 2 years. So, those are the things that I really believe is happening. Start point of valuations and the fact that COVID hit them worse than the other part and the regime changes. I think many of them have very good businesses, lowest cost of funds. 2 out of 3 actually have the lowest cost of funds in the country. That makes them very, very nicely positioned to capture any business that the market may offer. So this should be taken as an opportunity rather than anything else.
The opportunity that you talked about, and you kind of singled out private lenders here. What about the PSU banks? Because they've been playing catch up.
I said that the corporate side did not get impacted, and they have seen a significant bump up of the corporate banks. I do believe banks which are now focused incrementally more on retail. So I would put, let's say, an ICICI, SBI, Axis in that space. Stand to do better in the next period. Second, one other way of looking at banks is banks where you have a full array of subsidiaries, doing insurance, mutual funds, life and general insurance, etc. And there's, two names stand out over others. So that's a slightly different way of looking at things. I do believe valuations in the subsidiaries will hold out much better than that of the parent, and there will be a positive feedback loop. So subsidiaries do well, and the parents will hence also do better than others in the same space.
Okay. You started the interview and answered Nikunj by saying, look for the opportunities when it comes to the profit pool, the earnings. So can I ask you simply, what are the themes that you are currently looking at? IT, for example, does seem overstretched. Is this perhaps maybe the time to go overweight on pharmaceuticals?
So yes, we continue to be positive on pharmaceuticals. There are a lot of tailwinds for this space. What has happened in this space is that maybe it did well in the first round of COVID itself, and on that base could only consolidate. The API part of pharmaceuticals, which is an extension of chemicals, has a tailwind of China plus one, plus the backdrop of PLI policy supporting that space. So yes, pockets of pharmaceuticals can continue to do very well. Element of regulatory risk. We differentiate businesses which are exposed to the US. There, the regulatory risk is the highest, and the brand power is simply non-existent. So the earnings from a launch of molecule there should be seen should be less valuable versus earnings from a branded market like India, where we really see both the richness of the Indian business and the long period sustenance of the same to be of an order higher than the US business. So that is the makeup. Focus on pharmaceuticals, which are on the branded side, focused on India, and maybe APIs, where the world is the market and the regulatory risks are decidedly lower than people who formulate and sell.
Prateek, is construction and infrastructure a space that you will look at? Many believe that now that capex is opening up, but this is an interesting space to look at. More importantly, because most of these stocks are still under-owned and valuations are still very much attractive here.
Yeah. So our problem with this space has been that there are no entry barriers. At the beginning of the cycle, margins are nicer, and the trouble is by the time investors start to look at these names, the competition hots up and margins tend to disappoint. So we typically want businesses to demonstrate much better pricing power, and that is something which is non-existent here. I think on the capex side, yes, we are very positive. So government capex continues, but then because of improved wealth effect, because of lower interest rates, housing affordability has improved quite a bit. Versus construction, I would believe the housing companies could be a better investment.
Right. So, Prateek, if I were to ask you your buy, sell and hold list for 2022, given that year end is almost here, what's it going to look like?
So let me do some sectors rather than names. Yes, we are positive on themes like China plus one, which benefits chemicals and pharmaceuticals. There I did make a case for which space to look at. PLI beneficiaries, particularly in electronics, that is where the biggest spends would be, and FY 23 and 24 over 23 could see really large scale up there. In the healthcare side, by the way, hospitals is a space that one should not miss out. They were thought to be lower ROC businesses and got left out. But now some of them actually are delivering over 20% return on capital employed with long period sustained growth opportunity, which is there in the market like India. On the traditional spaces, I would say there can be once again relatively better performance by consumer staples. If FY 22 has been the year wherein inflation has come up, FY 23, as we go deeper into the year, could see inflation go down, and margins for many of these consumer staples would again start to look very good. So they would increase prices, margins would any which ways get restored over the next 1 to 2 quarters. And then as the input prices decline, you could see margins being better. So that's the space to also focus on.
Prateek, when do you think markets will start pricing in this inflation fear? US markets have been resilient, bond yields have not gone haywire, but at some point in time, if we don't see a drop in inflation, markets will start looking the other way. Uh, are we reaching there?
Um, I would believe no. Look at it this way. Uh, we are having high inflation. Fair enough. Uh, the components of inflation may be transient on the food side, but not so transient on the fuel side. So it will take some time to come off. But the point is that the level of interest rates being so low, today you can borrow for a housing loan at sub 6.5%. So even if you bump up interest rates, by 25 bips, by 50 bips, worst case 75 bips over the next 1 year, yet, given the strength of recovery, the increase in rates could be nicely absorbed. Is the first point. Second, increasing rates and sustaining it higher. Now, this is quite contrary to what we believe. Increasing interest rates and sustaining it higher could prove to be very difficult because hopefully this year you would see India getting included in global bond indices also. And that would mean 25 to 30 billion dollars of debt oriented flows coming into Indian paper in a sustainable manner. So, that's a low volatility piece of debt flows. That's a sizable sum of money that the economy will need to absorb. So chances are, yes, you can get 1 or 2 rate increases, but towards the end of the year and beyond, you could again see lower interest rates. Now, our interest rate, see, the whole trajectory won't be a straight line. But look at it this way, over 10 years, our interest rates have declined by 1.5%. US interest rates have declined by less than 0.5%. Today, our inflation and theirs look similar. Today, our currency is more stable versus the dollar versus any other time in the past. So, for last 4 years, we have seen a depreciation of 1.5% CAGR, which then means that we need not offer such high interest rates. So, that is something we should be ready for rather than expecting rates to go back to, earlier levels. Those earlier levels are far out, probably won't happen. So, chances are that growth will continue to be strong, would be able to absorb the interest rate increases in its stride. I would not be too perturbed by initial 25-50 bip increases in rates.
So let's see how the inflation story pans out in the market. It's been completely disregarded in the US despite inflation hitting almost a 40-year high. In the new earnings season also is going to be interesting to see. We have, of course, started to see India Inc. raise prices. Thanks a lot, Prateek Agarwal.